For every one corporate insider buying shares right now, there are 5 selling. The private credit market just saw its worst crash since 2008, and the guy I'm speaking to today called this 6 months ago. Steven Van Metre has been digging into the data nobody wants to look at. The labour market, consumer credit, delinquency rates. While everyone else was saying the economy was fine and accelerating, he was showing the cracks. Auto loan delinquencies are now higher than 2008. The personal savings rate just hit a 3-year low. The top 10% of Americans are propping up the entire economy through the stock market. When that breaks, everything breaks. Today's show is less about crypto, but it might be one of the most important shows you watch if you're in crypto. Bitcoin has never seen a real credit crisis. So the question is this just a normal pullback in Bitcoin's standard 4-year cycles, or is something much bigger breaking and cracking underneath the surface? That's what we're figuring out today. Give the video a like on the way in. Remember, nothing is financial advice. These are just opinions based upon the data and how 2 individuals on the internet see it right now. You should not be getting your advice from random strangers on the internet. Enjoy the show. This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research. Steven, thank you so much for being here. This is an absolute pleasure to be able to chat to you about all of the crazy kind of like underlying cracks that have been going on underneath the surface in essentially the US and arguably the broadening economy for quite a while now. So I know you've been speaking basically at length about what has been happening over the last 6, 12 months, the weakness in the labour market, the weakness in jobs data, the underlying cracks beneath the surface that have been arguably sort of like papered over in a range of different ways. Today, we just had some news from Blue Owl. I know you've spoken about Blue Owl at length in your shows. Could you just go into a little bit about sort of like what came out today, what you have been talking about, and what it kind of means more broadly, please?
Yeah, so there's this big private credit space. It's massive. So what happened is banks, post financial crisis, they really stopped being lenders in a lot of capacity. So the shadow banking system formed, and inside the shadow of the big banks, and it's not some secretive thing. I mean, the banks know it, everybody knows it's real, but the banks fund credit lines to a lot of these companies, and they go out and they raise assets, and they do what we'll just say are much higher risk loans that the banks really don't want to touch. And what happened all of a sudden is people are starting to realize that some of this money may not be good. We saw a couple blowups recently. I forget kind of some of the name of the companies off the top of my head. Tricolor, First Brands.
Yeah.
And now all of a sudden investors are saying, you know what, I think I want my money out. But unlike, say, an ETF or a mutual fund or something like that, you have to put in a redemption request, and there's a limit every quarter of how much money they'll let out. Well, their redemption limits are about 5% every quarter, and all of a sudden, all of their funds bust past that. They had more than 5%. But what's really interesting is their software fund, which is I think about 46% of the fund, or 46% of his software loans, which is very high. The industry average is closer to 20. The redemptions were like over 15%. They just can't do it because if they start liquidating, let's put it in maybe a simpler terms. You've got a mortgage backing a house and people want out. Well, if the house is upside down and you have to sell it to make redemptions, you've got a problem. That's the issue with these loans is right now there's some belief that they're only worth around 80 cents on the dollar. And Blue Owl doesn't want to let these loans go because if they have to start dumping them on the market, it's going to create further downward pressure, more panic, more people are going to want out. And next thing you know, this is kind of how credit cycles bust and things start to go wrong. So the solution was real simple. We're going to borrow against these funds to create some liquidity here, and then we're going to shut the door on at least one of them. Says you can't take your money out anymore. But what was really shocking to me is the buyers of this debt, which we can argue that the market is saying is not worth 100 cents on the dollar, for public pension funds and large insurance companies. They're hungry for the yield, which is obviously the attractive part of this. But what the market's saying, what investors are saying is, look, I want my money out because even though Nothing right now is saying we're on a, we're going to have a massive financial crisis. We could make some cases that there are signs that one could occur, but we're not, there's no immediate like, hey, things are falling apart. But investors are looking back to the financial crisis and saying, look, I've seen this before. And maybe it doesn't happen. But if it does, I can't get my money out of this stuff. So what could happen is one day I open up my statement and it might be worth 50 cents on the dollar, and I can't take money out to live on. I can't diversify. It's stuck there. And for how long? Who knows?
Absolutely. Do you think this is similar to 2008 in terms of, obviously the reason 2008 blew up, right, is because we had all these mortgage-backed securities, which were basically useless loans, or loans to not really credit-worthy individuals that were kind of packaged up. We are seeing something very similar happening across AI right now.
Yeah, but this isn't just an AI thing, and I think that's something I want to really impress on people is this isn't an AI-specific issue, because where private credit really comes into place is you have a lot of borrowing against inventory, the short-term needs that businesses have. So a really good example is I sell some products and the buyer gets it, but I don't get paid for 30 days. I have a net 30 or net 60 where I don't have cash until then, but I can prove that, yes, the inventory is in their hand. Yes, everything's good. I'm just waiting for payment. So what I do is I go to the private credit space and I say, look, I need money now. And they'll lend, a percentage of that. So what the market's starting to say is, because you go back and look at where this really got out of control was due to the tariffs. So there had to be a lot of front running. People needed money. So they went to the shadow banks and borrowed it. Then they needed money from the tariffs, and believe it or not, they borrowed that too. And we're talking some of these tariff interest rates I've seen, 15, 20% or more, weekly payments. I mean, these things are high. And this all works out, and typically with any credit bubble is, if everything just works through the system, it'll be fine. If all of this inventory moves, but what's happening is on the consumer side, what have we seen? Hours worked are stagnating. Inflation still running higher than incomes. We're seeing earnings are continuing a downward scale. You're seeing companies, laying off a little more here, a little more there. Consumers are starting to pull back. And what's happening is this inventory isn't moving. Now, had all this inventory cleared, we wouldn't be having this conversation. Now the risk is, what happens when this doesn't sell? How much does it have to get written down to actually sell it? And that's what everyone's starting to see right now is, companies like Blue Owl saying, hey, look, no problem, this is money good. And the pension funds buying are saying, yeah, we think so too. And everyone else is saying, yeah, we're not so confident about this.
Yeah, because they were actually saying, they came out and said on their own back, nothing to worry about. Whenever any large institution, large bank does that, that's a surefire sign to run for the hill.
Well, yeah, absolutely. But you look at what Walmart kind of reported in their earnings, that we're seeing kind of issues in the labor market. And really what it is, again, all this stuff was built because, and if you think about how this would have played out, you're a business and you think, okay, tariffs are coming. I've been squeezed at the margin for like the last 3 years. I've been struggling just to keep afloat. So I'm going to go and I'm going to front load as much of this as I can, because when the tariffs hit, when you come into the store and say, oh, well, I'm sorry, the price went up, it's tariffs. Little do you know that I bought this pre-tariff inventory, so I'm hoping to sell it at a higher price, clean up my margins, and clean all this stuff up. Well, what's happened is the inventory isn't moving. We look back to the holiday season. What did we hear beginning of last year, or 2025, right? Second half was going to boom. Second half showed up, didn't boom. We get to the holiday season. All right, the holiday season is going to boom. Everybody's been waiting to go out and just spend. Didn't happen. Now the reality is, you look at retail sales, 50% of all retail sales is the wealthiest 10% of Americans. Completely unsustainable. And then you start looking at things like the delinquency rate on credit cards is rising. Delinquency rate on auto loans, rising. Delinquency rate on student loans, straight up. And so what you're seeing is a lot of consumer stress. You're saying, look, I can't pay my bills. So how am I going to be expected to go out and buy all of this stuff? And I can't. We heard from Chipotle. People can't afford a $12 burrito. And so it's kind of interesting because we have, the big, Trump tax cuts, the big refunds, and that was supposed to really juice the economy and the markets. And we've seen that happen when times are good. But right now, the question is, if the tax refund, typical tax refund, I think was around 2,000, it's going to be estimated, 2,800 to 3,000. What is that extra $1,000 going to go to? Is someone going to get that and say, oh, you know what? I can't wait. I'm going to run out and spend it. Or they're going to say, you know what? I'm behind on my bills. I'm worried about losing my job. I'm seeing demand at my company is going the wrong direction, and that means they're going to cut hours again. Maybe I'm going to lose my job. In that situation, that money goes to debt service, it goes to cleaning things up, or it goes into savings. And so there you come back to this problem is you have all of this inventory, all of these companies have borrowed just crazy amounts of money to stay in business. And now in the market's saying, look, we don't think this is worth 100 cents on the dollar. Blue Owl probably doesn't believe it either, because at one point they were looking at flipping one of their funds into another one or doing something with it. I forget the exact details. And they already they had told people the investors were going to take a 20 to 30% haircut. So if that was prior to them gating the funds, so what they're kind of telling you is, look, we think this stuff's worth 70, 80 cents on the dollar. What is it going to be really worth when the economy slows down even more, or if the labor market goes? It's going to be worth substantially less. The problem you have is, can these private lenders, can they stay in business? Maybe not. Will the businesses stay in business? Maybe not. But if you're an investor in this, what you're finding out is they might just lock the doors and throw the keys away, and you can't get out. And that means your net worth, your retirement, your financial future, gone.
And I think this is just highlighted, right? We had a Q4 GDP print today. And if you it was under expectations. We had 1.4% expecting around about 3%. But if you just scratch beneath the surface of that print, what you see is that almost all of the gains basically came from healthcare. They came from, staples. They came from the parts of the economy that have to keep turning for people to survive. That is not signs of a well-functioning economy.
No, I mean, a lot of that print is, the media is going to position it as, shutdown related issues. And of course, that's, at this point, that's what, you never hear the political elites, you're never going to hear a central banker come out and say, hey, you know what, I think we're about to have a recession, because then people are going to be like, what? Well, then I'm going to stop spending. So you have to spin it somehow. And they're going to say, look, okay, this is all due to the shutdown. Things are going to turn around. But there's no signs of it. That's the really underlying issue here. You look at what's going on in the higher frequency data, we don't see it. Continued claims were supposed to come down, and they're stuck around 1.8 seasonally adjusted, 2.2 non-seasonally adjusted. I mean, how long does that keep going on for? I mean, if the economy was turning around, if demand was going to pick up, then you would see a change in that. We're just not seeing any evidence, and that's a big problem, because you look at how do economic cycles come to an end? How do you get financial crises? It's when credit dries up. It's when the bubble bursts. And when the banking system starts to see, wait a minute, people want out. Well, so you think about Blue Owl's perspective. You've got a company out there that may need money. Blue Owl can't keep money in the funds so they can lend out. So now they got a problem is money wants out. So that means they have to slow down their lending. So what happens is now you've got a small business that maybe it's look, I finally got some inventory sold. I don't get paid for 2 months. I need to get paid now, or I'm out of business, or I got to lay people off. And that's how this thing starts to get out of control, is when the banks can't keep the credit spigots flowing. Next thing you know, they start to panic, underwriters start tightening up, and then as credit gets cut off, then the dominoes start to fall off. And that's really the risk here. That's how financial crises start. We're not there, but if we see the delinquency rate continue to rise, if we see banks tighten lending standards, there's an absolute risk here that this could happen. And particularly you think about the AI thing, and that's kind of interesting too, because they need, I don't know how many trillions of dollars that the experts have said they need. But nevertheless, if you're a big company like Oracle out building data centers and you run out of money and the banks won't give it to you and the data center is half built, well, what do you do now? You still got to service the loan, but now you have a useless asset. That's the problem with credit bubbles, is once the flow starts to get cut off, then things come unraveled.
What are you looking at for I know we're seeing signs right now. Which particular area of delinquency is the biggest red flag for you?
Consumer delinquency, absolutely. I think commercial real estate, they have really papered that thing over. They've really kicked that can down the road, and for good reason, because you look at the small and mid-sized banks, you get the regional banks that do those type of loans. A lot of people think, oh, is it the B of A's and JP Morgans and Wells? No. They a little bit, but by and large, they don't touch that stuff. So you have a lot of buildings that they just won't write them down on the balance sheet. A good reason, because the banks would go illiquid. See what happens when that happens? Everyone wants to yank their money. Well, you can't do that. So since that side is being kind of propped up artificially, it's really the consumer side, because consumer 70% of the economy. When they cut their spending, it's game over. And what did we just see today? The personal savings rate hit October 2022 lows. You heard again Walmart say, we're seeing issues here. General Mills said people aren't buying Cheerios. So what's going on with the consumer is inflation's gone up. Their wages have been stagnant, relatively speaking. And they've been draining down their savings, hoping the economy turns around, because everyone keeps telling them it's going to turn. Not happening. So now you're seeing delinquency rates go up. So it's credit cards and automobiles. Those are the ones I'm watching. I think we learned from the financial crisis that people aren't going to stop paying on their house until they have to. But I think people are more apt. If you don't have a job, well, I don't need a car. I'll figure that out. I'll figure out if I can get one, and there aren't any right now. I'll deal with my credit card later. Maybe when I get that tax refund, I can put it towards that. But it's really the consumer at this point. When they've tapped out and they say we're done, it's game over.
Yeah, I think we're definitely seeing that sort of behavioural kind of like leave your sinking ship that you need the least. If you look at delinquency rates of auto loans, I mean that chart looks awful. It's just up and to the right.
Well, it's higher than it was in 2008.
Yeah.
There's a lot of denial out there that somehow this gets better, but every time everyone says it does, the only thing, and you'll hear people, they'll say, well, Steve, the stock market's up, so you're wrong. Historically, which is interesting, is you can look at comparisons of the stock market, particularly to a lot of labor market indicators. This is the biggest disconnect we've ever had, at least in data that I can see, because if the stock market was following the labor market, it would be down quite a bit from here, which tells us, again, there's a potential risk there that when the stock market goes, then the last big consumer, again, the wealthiest 10% of Americans, once they get spooked and stop spending, now all of a sudden the bottom, 90%, I say that figuratively because they're bigger, but their spending power is equivalent. They can't make up for it. So right now, the entire U.S. economy is being propped up by the stock market. It's being propped up by the wealthiest Americans. If the stock market does end up going down and they cut their spending, there's no way this thing gets propped up.
What do you think is the key driver of that disconnect? Because it seems like all of the things that we used to use to decide that the economy is not good, a steepening yield curve, the uninversion in the first place, like all of these things that typically precede or show recessions, the economy just, the stock market at least, just seems to be climbing this wall of worry, and it kind of keeps going.
Yeah, there's a couple of factors. One is definitely passive investing. We can talk more about that. Retail investors have been very aggressive in this market. I mean, a lot of data says they've been beating the pros, and no doubt. I mean, if there's a dip, they are there to buy. The other big factor, and this is one of my recent views on why I think the market is peaking and rolling over. I mean, the Nasdaq's very clear about this. Is you had these massive corporate share buyback programs. So, anytime there was a dip, some professional advisors are, and big money managers are like, I don't know about this. Retail's like, oh, I'm going to buy. Well, guess what? All that corporate flow, they were buying too. But if you look at the Nasdaq chart, it's really interesting. You go look over the last 9 months, 3 months, it's gone nowhere. And so this is really interesting because retail claims are buying, and they are. Institutional money managers, all the data says they're all in, and they are. Hedge funds are leveraged long, hedging, but they're leveraged very, very, very long. So why isn't this thing going up? And then the data starts to come out. Oh, corporate insiders, they're selling in a big way. In fact, what's notable here is for every one corporate insider, and I'm talking this is CEOs, CFOs, we're talking the upper echelon, for every one buyer, there's 5 sellers right now. And that's really staggering because they must know something that no one else does. So either they think, okay, the economy is going to slow down, or I think this is a bigger factor here. we'll use Oracle, perfect example, negative free cash flow this year, projected to have even more negative free cash flow next year. We're looking at the Mag 7. What do you see outside of Microsoft? They all should be spending 92% of their cash flow on Capex. So what do you do if you can't go out and keep borrowing money to keep funding this? What's one thing that every company can cut immediately? Corporate share buybacks. And if you cut that, you take out the biggest buyer in the market. Now, if you're a CEO and you're looking at all of this and you're like, man, I'd like to unload a whole bunch of shares before that goes away, that makes perfect sense to me. And so what a lot of people don't realize is, I think, that if you pull corporate share buybacks, if they end up even dropping by half, next thing you know, there isn't enough flow to keep the market up. It starts to validate what I'm seeing here. And then that's really what turns the tide, because without people, if retail is running out of money, we see that institutional money managers, according to Bank of America, are down to like 3.2% in cash, one of the lowest in decades. There's a company that looks at mutual funds. They said they're down to 1.1% in cash. That's nothing. Next thing you know, you've got nobody left here to buy. And that's the problem. When buyers are gone, next thing you know, the market rolls over and then starts to play catch down to a lot of other assets. You look at like private credit, you look at some other correlations to the market, and you can see that, somebody's standing out there by themselves. And that's right now, it's, the S&P and the NASDAQ. But if they start to flip, if the labor market goes, you start losing your passive flows, they get cut back. And next thing you know, the market is just so high that it needs a certain amount of flow to keep it up here. Without that, the gradual move is down. And then next thing you know, you start getting some systematic selling from machines, and then you start seeing people panic. And next thing you know, more selling begets more selling. That's the real risk here, is that at some point this flips, and then that takes away, of course, the wealthy spending, because, if their net worth is dropping, 20, 30%, well, their spending is going to get cut. And that becomes kind of the end game for the cycle here.
Absolutely true. I think last year, the data hasn't come out exactly yet, but about $1 trillion were issued in buybacks in the SPX. So just absolutely enormous figures that basically are now going to go into capital expenditure. And if we look at that Capex from the Mag 7 especially into AI, there was a study that was done last year. Deutsche Bank came out and said, look, if the Mag 7 hadn't been doing this Capex, or we hadn't seen, not necessarily from just Mag 7, but hadn't seen this Capex, the US would arguably be in a recession.
Yeah, I agree with that.
Is this capital expenditure enough to continue this sort of like wall of worry climb, or are we now really, really getting quite close to basically this becoming a big problem?
Yeah, so let's go at this two different ways. First, let's talk about the corporate share buyback, because based on the very latest data that I can find, corporate share buybacks have only dropped by 7%. And if that's enough to keep the market from going up, what happens if they cut back by 12% or 15%? So there's some very real risk here that actually happens. As far as the AI issue is, now the question is becoming when do these companies stop spending? Because the idea was this was supposed to bear some fruit. We were supposed to see it. Right now, the argument is it's not really doing a whole lot. Some corporate CEOs have been seeing in interviews. They're saying it's not really enhancing productivity like we expected it to. There's not really generating any revenue. In fact, obviously it's costing companies money. Now the question is, how much more, for how long does this go on? Does it go for another year, 2 years, 3 years? Is there an end point? And that's what the market's starting to look at right now, is these cash cows that have really been just driving the market higher just year after year. All of the spending and buybacks, it's gone. And that's why in the recent Bank of America fund manager survey, they interviewed fund managers and said, what's the number one thing you want corporate executives to do? They said, cut back your Capex spending. Because they know if you don't cut it back, you're going to have to cut your buybacks. If you cut that back, I can't get out of this market because everybody's in. That's always a problem. When everyone's on one side of the market, it's the time to start looking the other direction, because at some point the tide turns, and the door to get out right now, it's pretty small.
Which areas of the market are you looking into?
Get into, or what I'd be getting out of?
You just said there's other areas of the market that you must be looking at because everyone's looking over here. Where are you looking?
I mean, if you look at the market, I mean, the Nasdaq is very clearly showing you it's in a topping pattern. For me, if you like the short side of the market, you definitely want to be looking at that. There's no question that there's potential there. The bond market's getting interesting. You look at the long bond. I think it pulls back here in the short term, but if you look at price wise, it's holding above its 5-year volume profile, and the big banks have been buying. I mean, all the data is very clear. The banks are buying up on the long bond. Fed's not cutting yet. So you look at opportunity. Potentially, you want to look over there. What I just like to look where no one else is. When everyone says that this is the worst asset class you could never should own, I'm like, really? Well, let's go take a look and see what's going on. And right now, you see everyone bullish on stocks, bearish on bonds, and based on the charts I look at, data I'm looking at, it tells me that the trade's going to be, short the equity indexes, be long the bond market.
Yeah, yeah. I think we've seen more short open interest in TLT, which is like the 20-year. It's like a ETF of long durated government debt, basically 20 to 30-ish years. There's more short open interest in this than ever before, sort of like 5 times the average, which is crazy. I mean, it's so much higher than normal, and you've got an enormous amount of people offside on these long durated bonds. Why are they so offside on this particular ETF? And do you think that this is going to be a safe haven at some point if things end up going pretty south here?
Well, there's no question. There's nothing about the treasury market that's changed. I mean, globally, they're a safe haven. What's changed is people are really buying into the debasement trade that, that somehow the government is printing money. I mean, they can't. They don't have any mechanism to it. The Fed doesn't either. But, they're running deficits. That's debasing the dollar. Well, by design, the dollar is going to go down over time anyways. But nevertheless, that's acceptable as a reserve currency. But the notion is, the belief right now is that, people have to get paid for this debasement, in terms of higher interest rates. That's why you're seeing the big bets on it. That's not going to play out at all, because long-term interest rates are a function of 2 things: growth and inflation expectations. So, all right, let's look at inflation. It's not gone anywhere lately, but if you look at the direction of it, if you look at consumers pulling back, inflation is going to trend down. So what about growth? Well, that's the labor market. So what is it starting to tell us? Well, there's weakness. So all signs are saying that growth and inflation expectations are more likely. Now, from a trade, if you're looking to short-term trade this, I wouldn't be buying it on a short-term trade. I'd wait for a little bit of a pullback before I would be looking to take a decision. On a longer-term trade, the banks are so believing in this that they've been buying these things by the droves. So you look at those conditions of what would drive interest rates lower. It's not debasement, it's not deficits, it's not the Fed doing QE. It's all about growth and inflation expectations. And the market believes, again, that's going to turn around, but there's nothing in the data, and I wish there was something, there's nothing in the data that suggests that's going to happen.
And so I know from all of your work, you tend to believe that the bond market basically is the setter of what the Fed ends up doing. They're the Jerome Powell, whoever else comes next, Kevin Walsh, whatever. He's just sitting there. He's in the passenger seat. It's what's going on in the economy, what's going on with everything else that's really driving forward what they end up doing. With that in mind, where do you think they can go this year?
The Fed? Well,
yeah, the Fed.
You're right. The Fed is a passenger in a vehicle that follows 2-year treasuries. I mean, you could, or 6 months. You can look at anything you want, 6 month or 2-year or anything in between. Put it on a chart with the federal funds rate, and you will see the Fed does not lead; they are a follower. And of course, we've heard that from Treasury Secretary Basant, repeatedly here, because he's a former hedge fund manager. He knows the bond market, and he keeps saying like, "Hey, look, 2 years are going down, Fed. You need to cut." The answer to that question is what happens with the labor market, and does it gradually continue to come down until it stabilizes, where in an equilibrium with demand, or does demand evaporate? I don't know. What we do know is the front end of the curve. So we're talking, T-bills around, 3-month range. If that starts to drop, that's a sign that financial conditions are tightening. So that becomes a worrisome issue here. If we start seeing, front end of the curve drop, big problems coming. intermediate long in the curve are more growth and inflation expectations that do eventually follow. But I would not be surprised by the end of the year if the Fed continues to cut. Now, historically, this is what they should be doing. I mean, I think we've had a few cuts now. There's no hike going forward, even though they've kind of suggested that in the minutes recently. The reality is the Fed cuts this, 3 times or whatever. There isn't a hike. After this, there's going to be more cuts. The labor market's showing it. Consumers are showing it. Delinquency rate's showing it. Private credit is showing it. You start looking around and you say, okay, well, why would I raise rates here even if inflation went up? Because if inflation goes up, the labor market isn't going to hold up. The delinquency rate is going to continue to go up. So there's just too many issues here for me to say the Fed's going to hike rates. The only question is how many times are they going to cut rates? That's going to depend on, do we continue to see a slight stair step down where economy goes plateaus and dips a little bit, and plateaus and dips a little, or do we get to a point where it starts to go off a cliff? No evidence that happens yet. Would it surprise me if that happened? It would not.
And what do you think about the Supreme Court ruling of Trump's tariffs today? Has that got any impact?
Not really, because I think many people thought that the Supreme Court was going to strike it down. They made no comment about do people get a refund? The courts can drag that on for a very long time until they come up with oh well, it's some other form of something else. There's already Trump already said, and his team said, look, there's lots of other ways we can go here. There's at least 3 before you get into the complex ones, but are they going to get rid of tariffs? No. Could they call it something else at some point? Absolutely. But that's not going away. And while I do agree that there's tons of businesses out there that would love to get that tariff money back, even if they do, by the time they do, I think if they do, it's going to be way out in the future. There's going to be tons of court cases. And it would, you think it would look bad on the administration if they had to refund it. They're not going to want to do that. They're just going to call it something else. There's plenty of other codes that they can use. But yeah, I mean, you look at the market reaction, the market shot up in early trading and it's kind of gone nowhere since then because I think the reality is there's still going to be tariffs. Small businesses are still being squeezed. And the reality is, even if the tariffs went away tomorrow, is it too late? I think it is.
And where do you see gold fitting into all this? Obviously, we've seen central banks buying more gold than ever before over the last, basically since 2022, right? There was quite a clear shift in 2022. I think it was as a result of Russia being axed from the treasury market, and 9% inflation in that year. From that period, we've seen obviously central banks begin to just go and almost hedge their bets, right? Is the outperformance of gold to the SPX last year and continued arguably into the start of this year, is that like a canary that's in the coal mine that's also showing these deep underlying cracks, or is that just something completely separate?
I think it's all about the debasement trade. And I think that's people just got bought into that, and then gold started going up, and then you saw Chinese consumers speculate on it, American consumers, and a lot of people are saying, well, I'm buying the physical. Well, great. I mean, as you should. But there's a lot more people that were buying, call options. The paper market really drove the price up. And that's a big risk because you look at, past recessions and financial crises, people say, well, gold only goes up. Well, there's a point where it comes down. The really question is why does that actually happen? Why does it come down before it goes up? So let's put this in a simple perspective. You have husband and wife, they have some kids, and they got a mortgage and car payments and credit card debt and everything else, student loans, and one or both of them lose their job. They're sitting down at the dinner table and like, well, got to pay some bills here because don't want to tell the kids can't feed them tonight, and we don't want to move in with mom and dad just yet. So what do? Do you go to your 401k where you're going to sell it and pay taxes and an early withdrawal penalty, or do you look to your non-qualified assets? Now, in the past, we did not have cryptocurrencies, obviously, so what happened? People sold gold. There's a liquid market for it. So my expectations would be is, when push comes to shove, people are going to say, yes, I'm bullish on crypto, I'm bullish on gold, I'm bullish on silver. The reality is you're only bullish until you find out that, oh my God, if I pull money on my 401k, I got 10% withdrawal penalty, minimum 15% federal tax, maybe a state tax. Oh gosh, I think I'll just go over here and sell this stuff. And that's the problem. The other issue, particularly with silver, is a big run up in price. What did you see behind the scenes starting to happen? You saw a lot of, retirees, older people, people that had back when I was a kid, my parents had a silver set. My grandparents had a silver set. Well, people don't entertain that much anymore, and they certainly don't use that stuff. And when the price goes up, what happened? They said, you know what? I'd rather have the cash. So that's another issue. You see people that need money being forced to sell because price goes up. They don't care about their gold watch because they need money. And so that becomes two separate issues here. Higher price means you bring out people that need money, but a recession means, hey, do you want to sell something for a potential capital gain because you bought it, or do you want to sell something that's fully taxable? People are going to sell the one that has the least tax impact first, even though they don't want to, and they're going to do that hoping, yes, they get a job, things turn around. When that doesn't happen, then they'll turn to their qualified assets. So that's one of the reasons why I know a lot of people say, gold is only going to go up. I said, well, I understand that, but it usually goes down first. And there's a very good reason why. It's because people need money. You sell the quickest and easiest thing you've got. But beyond that, the real underlying issue is it's the labor market, it's incomes. And it's not just the U.S., it's all over the world. Consumers have been falling behind inflation. And when you can't buy risk assets. Sometimes you end up selling them. So if you structurally, you look at the global economy, the reason stimulus doesn't work. And the big question was, will the tax refunds that hit the U.S., will they do something? So far, they've done nothing. Well, why? Because people are running. If you're delinquent, I mean, if you get an extra $1,000 and you're $1,000 behind your credit card bill or your car payment, are you going to go down and spend it, or are you going to get cut up on your bills? You're probably going to get cut up on your bills. That would be my guess of how people are going to do it. In that case, stimulus doesn't work. It's why China's housing market can't turn around. I mean, we stimulate and then it goes down, stimulate and goes down, because it's not about stimulus. It's about, in the end of the day, jobs and incomes. And globally, that's going the wrong direction.
Mm-hmm, mm-hmm. Amazing. Steven, this has been an incredible conversation. Would you like to tell everyone where they can find a bit more about you, please?
Oh, yeah, you can find me on YouTube under Steven Van Metre. I publish a regular show, as you know, and so you can find me on Twitter. I post some of my stuff on there, but mostly on YouTube.
Yeah, awesome. Yeah, go and check out Steven's YouTube, guys. It's filled with incredible information, and I highly recommend it. So just want to say another massive thank you for coming on, Steven. It really means an awful lot to me. Appreciate your time.
Honor's all mine. Thank you, my friend.